The silver breakout has started. Most investors haven't noticed something just happened in the silver market that hasn't happened in over a decade. And almost nobody is talking about it. Not the mainstream financial media, not your broker, not the analysts on TV telling you to buy index funds and relax. But the data is right there, in plain sight, if you know where to look. And if history rhymes, even loosely, what comes next could be one of the most significant wealth transfer events of this generation. Stay with me. Because by the end of this video, you're going to see silver in a way you've never seen it before. Here's what we're going to cover today. We're going to look at exactly what just broke out in the silver chart and why technicals alone don't tell the full story. We're going to go deep into the macroeconomic forces that have been quietly building pressure underneath this market for years. We're going to talk about why silver is fundamentally different from gold, and why that difference actually makes it more explosive in certain environments. And we're going to examine what institutions, central banks, and smart money have been doing quietly while retail investors were distracted by tech stocks and crypto headlines. Most investors completely miss this, not because they're not intelligent, but because silver is boring. It's overlooked. It sits in the corner of the financial world like an afterthought. That's exactly why it matters right now. The biggest opportunities in markets rarely announce themselves loudly. Section 1. The chart nobody is watching. Let's start with the price action. Because something technical just happened that market veterans recognize immediately. For years, and I mean years, silver had a ceiling. A hard wall of resistance that it kept running into and bouncing off, roughly in the $26 to $30 range, depending on how you draw it. Every time it approached the zone, sellers showed up. Momentum died. The metal faded back down. That kind of repeated resistance is called a consolidation pattern. And consolidation patterns in market history do one of two things. They either break down completely, or they compress energy, like a coiled spring, and when they finally break out the other direction, the move is violent and fast. The question was always, which way? And now we have early evidence of an answer. Silver has been pushing through that resistance zone with increasing conviction. Volume is picking up. The structure of the chart has shifted. What was a ceiling is beginning to act like a floor. Now, here's where most retail investors make a critical mistake. They see a breakout and they think it's about the chart. They think it's a technical event. It's not. Charts don't move markets. Fundamentals do. Charts just tell you when the market is beginning to price in those fundamentals. So the real question is, what fundamentals just changed? And that answer is far bigger than most people realize. Section 2. Silver isn't just a metal. Here's the first thing you need to understand about silver that makes it unlike almost any other asset on the planet. It lives in two worlds simultaneously. On one side, it's a monetary metal. It has been used as money for over 5,000 years, longer than most civilizations have existed. Every major empire that ever rose and fell used silver as currency. It's embedded in the DNA of what humans consider valuable. On the other side, it's an industrial metal, and not just any industrial metal. Silver has properties that are almost irreplaceable in modern technology. The highest electrical conductivity of any element. Extraordinary thermal conductivity. Antimicrobial properties. Optical reflectivity. You find silver in solar panels, in electric vehicle components, in semiconductors, in medical equipment, in 5G infrastructure, in defense technology. This dual nature is silver's superpower, and it's also why it's so misunderstood. When fear drives the economy, investors flee to silver as a safe haven. Monetary demand surges. When the economy is growing and technology is expanding, industrial demand for silver surges. In theory, there should always be a tailwind for silver, either from fear or from growth. But here's what's happening right now that makes this moment unusual. Both of those tailwinds are blowing at the same time. And the supply side of the equation? That's where it gets very uncomfortable for anyone who thinks this metal is fairly valued. Section 3. The supply crisis nobody is reporting. Let me give you a number that should stop you cold. For the past 3 years, the silver market has run a structural deficit, meaning the world is consuming more silver than it is mining. Not slightly, significantly. According to data from the Silver Institute, the global silver deficit in recent years has been among the largest ever recorded. Demand from solar energy alone has exploded. Solar panel production now consumes a staggering portion of annual silver supply. And that number is growing, not shrinking. Meanwhile, on the supply side, what's happening? New silver mine discoveries have been declining for years. The easy deposits have been found. The large high-grade silver mines that used to flood the market with supply are aging. Production costs are rising. Environmental regulations are tightening. And critically, most silver isn't mined as a primary product. It comes as a byproduct of copper, zinc, and lead mining, which means you can't simply decide to produce more silver. You have to produce more of those other metals too. The supply response to higher prices, which usually fixes commodity shortages over time, is unusually slow and constrained in silver's case. Think about what that means for a moment. You have rising industrial demand from the green energy transition. You have rising monetary demand from economic uncertainty. And you have structurally constrained supply that cannot respond quickly. In Economics 101, this combination has one outcome. Price goes up. The only question is the timing. And the timing, as we'll see, is being forced by forces far larger than the silver market itself. Section 4, the macro backdrop. Why this is different. To understand why silver is moving now, you have to understand what's happening in the broader global economy. Let's go back to basics, really fast. For decades, the global financial system was built on a foundation of cheap money, low interest rates, easy credit, expanding debt at every level, consumer, corporate, and most critically, government. The United States alone is now carrying over $34 trillion in federal debt. Interest payments on that debt are now consuming over $1 trillion per year, more than the entire defense budget. Read that again. The U.S. is spending more money servicing its debt than it spends on its military. And this isn't a political statement, it's just arithmetic. Now here's where it connects to silver and to every hard asset. When a government carries debt loads this large, it faces a fundamental choice. It can raise taxes, politically brutal and economically suppressive. It can cut spending, almost impossible politically. Or it can inflate the debt away. Inflation is, historically, the path of least resistance for heavily indebted governments. And what does inflation do? It destroys the purchasing power of paper money. Every dollar you hold slowly loses its ability to buy things. The denominator of every financial calculation shifts beneath your feet. And in that environment, historically, without exception, real assets rise. Things with tangible value. Things that can't be printed. Gold, real estate, commodities, silver. But wait, there's a wrinkle. And this wrinkle is what most gold investors miss when they think about silver. Section 5, the gold-silver ratio. The sleeping indicator there is an ancient relationship between gold and silver that has existed for thousands of years. Historically, going back centuries, roughly 15 ounces of silver could buy 1 ounce of gold. That ratio wasn't arbitrary. It roughly reflected the natural abundance of the two metals in the Earth's crust. Over time, as markets evolved, that ratio fluctuated. But for most of modern financial history, the ratio stayed somewhere between 40 and 80, meaning it took 40 to 80 ounces of silver far to buy 1 ounce of gold. Do you know what the ratio is right now? It's been trading in the range of 80 to 90. In extreme moments, like during the COVID crash in 2020, it briefly spiked to over 120. What does this mean in plain language? Silver is historically cheap relative to gold, dramatically, measurably, undeniably cheap. Now, markets can be mispriced for a long time. Everyone knows this. The ratio being elevated doesn't mean it automatically corrects. But here's the pattern that serious macro investors watch closely. Every single time the gold-silver ratio has reached extreme levels and then begun to fall, meaning gold and silver both rise but silver rises faster, it has historically coincided with a major secular bull market in precious metals. It happened in the late 1970s, when silver ran from $5 to nearly $50. It happened in the early 2000s bull market. It happened after the 2008 financial crisis. And each time, the investors who understood the ratio got in early. While the crowd was still watching gold make headlines, silver was quietly compressing, coiling, preparing. That ratio is beginning to shift now. And if history rhymes, even loosely, the math begins pointing towards silver dramatically outperforming gold in the next major leg of this precious metals bull market. Section 6. What smart money is actually doing. Here's where it gets interesting and slightly unsettling. Most people see silver as a fringe investment, something for preppers and conspiracy theorists and people who distrust the system. But look at what institutions have been doing quietly. Central banks around the world have been buying gold at the fastest pace in recorded history. That's documented, it's not a theory. The data from the World Gold Council shows central bank gold purchases have been at multi-decade highs. Now, central banks don't buy silver directly in the same public way, but their behavior is a signal. When the institutions that literally print money decide to stockpile hard assets, what are they telling you about their confidence in paper currency? Think about that carefully. At the same time, industrial giants in technology, energy, and manufacturing have been quietly locking in silver supply contracts. Companies that depend on silver for production don't leave their supply chains to chance when they see structural deficits forming. Meanwhile, ETF holdings of silver, which reflect retail and institutional paper investment, have been shifting. The smart money positioning is changing. Most people see the silver price and think nothing is happening. They look at it compared to crypto and think it's boring. But below the surface, the tectonic plates of this market are moving. The crowd always discovers the trend late. That's not a criticism, it's just how markets work. Information is distributed unevenly. Attention is distributed unevenly. And by the time something is on the front page of financial media and being discussed at dinner parties, early move has already happened. The question you have to ask yourself is, where are you in that cycle right now with silver? Section 7, the geopolitical dimension. There's one more layer to this story that most retail investors never think about: geopolitics. We are living through a period of accelerating de-dollarization. That word, de-dollarization, sounds technical. But what it really means is this: countries around the world are slowly, deliberately reducing their dependence on the US dollar in international trade and reserves. Russia and China have been settling energy trade in non-dollar currencies. Saudi Arabia, historically the cornerstone of the petrodollar system, has been discussing accepting yuan for oil. The BRICS nations have been openly discussing alternative reserve arrangements. None of this happens overnight, and none of it means the dollar collapses tomorrow. The dollar remains deeply embedded in global finance, but the direction of travel is unmistakable. And when the dollar loses dominance, even partially, commodities priced in dollars historically rise, because if the dollar weakens, it takes more dollars to buy the same amount of a real thing: oil, copper, agricultural products, silver. There's also a second geopolitical dimension specifically relevant to silver: the energy transition. Governments worldwide have made commitments, through legislation, subsidies, and mandates, to massively expand solar energy infrastructure. Solar panels require silver. There is no viable substitute at scale. The silver demand embedded in global climate policy alone represents a structural shift in the demand picture that will play out over decades, not years. This isn't a forecast, it's already in motion. The factories are being built, the panels are being installed, the silver is being consumed, and the mines cannot keep up. Section 8, the risks now. I want to be honest with you, because this is where many finance channels fail their audience. Silver is a volatile, unpredictable asset. It can be wrong for a long time before it's right. It can fall sharply and test your conviction in painful ways. In 2011, silver ran all the way to nearly $50 an ounce. Everyone was excited. The bull market felt unstoppable, and then it crashed. Slowly, painfully, over 4 years, it fell back below $14. The fundamentals were not wrong. The timing was. So if you're watching this and thinking about silver as a way to make a quick trade, understand what you're actually dealing with. Commodities move in long cycles. The payoff is for patient capital, not for people chasing short-term momentum. There's also the risk that industrial demand weakens in a global recession. If the world economy slows sharply, industrial silver demand could temporarily fall, even if monetary demand rises. And the Fed, always the Fed. If the Federal Reserve manages to maintain high real interest rates for longer than the market expects, the near-term pressure on silver and gold remains real. I'm not here to tell you what to do with your money. I'm here to tell you what the landscape looks like. What you do with that information is your decision. But understanding the risk is part of understanding the opportunity. The window, so here's where we land. We have a metal that has served as money for 5,000 years, sitting at historically depressed valuations relative to gold. We have a structural supply deficit that is worsening, not improving. We have an industrial demand revolution driven by the energy transition that is locking in decades of consumption. We have a macroeconomic backdrop of record government debt, currency debasement pressure, and accelerating de-dollarization. We have a technical breakout beginning to form after years of compression. And we have a market where most retail investors aren't paying attention yet. Every one of these factors has existed individually at various points in history. What's unusual, and what serious macro investors recognize, is that they are converging simultaneously. Markets are forward pricing mechanisms. They don't wait for everyone to catch up. They move when enough informed capital begins to position ahead of the obvious. By the time silver is on every financial channel and your neighbor is asking you about it, The easy money will have already been made. The window between early and obvious is always shorter than people expect. Here's the question I want to leave you with. When the next chapter of this story is written, and it will be written, one way or another, which side of the trade will you have been on? Not the side that watched, not the side that almost acted, but the side that understood what was happening before the crowd arrived. Think about that.